Can't I do better than an IUL by investing in a mutual fund? I get asked that question all the time. I've been asked it for now ever since 1980, okay? They sometimes think, well, I can avoid upfront costs and penalties with an IUL. Well, the only time you're going to actually incur any penalties on an IUL is if you cancel early. This is a long-term investment. And so I've said this numerous times on this channel. You choose investments based upon which ones generate the most, okay? Your income that you want down the road, which investments are going to generate the most after tax, fees, and everything at the time in life that you're going to be using the money the most down the road, okay? So you use IUL for long-term goals, and any of these supposed costs or penalties only come into play if you start one and then you bail out or you cancel in the first couple of years. All of those costs and penalties are recouped as you continue with an IUL, and it ends up knocking the socks off of putting the same amount of money into a mutual fund. So get ready. I'm going to show you the difference here. You're going to be blown away. I'm Doug Andrew, and I've been doing this now for 5 decades. And so in this episode, let me dive deep into why a properly structured max funded IUL will knock the socks off of a mutual fund, okay? Now, to be honest with you, I started as a financial strategist in 1974. Yeah, I've been around the block for a long time. I might have an Apple Watch on right now, but my first watch was a sundial, and my first pet was a dinosaur. I'm that old. In 1974, I got my Series 1 securities license and my insurance license, okay? My Series 1 securities license, which they don't even offer anymore, could allow me to sell in a stock, bond, mutual fund, or whatever. And from 1974 until 1980, in 6 years, I ended up being responsible for over 3,000 clients in 13 Western states, okay? And I was trying to do my best by having their money invested in mutual funds. I was a big buy term insurance and invest the difference proponent. And then in 1980, that all changed because E.F. Hutton, who is the brainchild behind the emergence of universal life, which then later got enhanced with indexed universal life in 1997, it was buy term invest the difference under a tax-free umbrella, okay? And a lot of agents still do not understand that. But I had over 3,000 clients in mutual funds. And what I was trying to do is earn an average of 12%. Now, I'm going to explain that is very hard to achieve by rebalancing or diversifying or trying to time the market. But let's assume that for right now. Let's assume that you could average 12% because you get some pundits out there like Dave Ramsey that says, hang in there, you should average 12%. Now, most Americans do not average 12%. I'll explain why in just a moment. But assuming you could, okay, I came to this realization that if I could average 12% for my clients, okay, that's not what they're netting, okay? A mutual fund, even if it's an IRA or 401k, you're not netting 12% after taxes, let alone fees. Now, most asset managers charge at least 1% in fees, but taxes are going to be due sooner or later if you have a tax-deferred IRA or 401k. So let me simplify this. Let's say that you accumulate $1 million in a mutual fund, okay? And now you want to start withdrawing 12% a year because you're earning 12%. Theoretically, you ought to be able to pull out 120 grand a year without depleting your $1 million nest egg, right? If you're earning 12%, you can pull out 12%. So you pull out $120,000 and that shows up on the front page of your 1040 tax return. And so between federal and state income tax, many Americans, when they retire, because they've killed all their deductions by paying off their house and they sold their business, you don't have those deductions anymore. Your kids are gone. You can't deduct them anymore, even if they move back in. You're not contributing money to IRAs or 401ks. You don't have those deductions. So many savers find themselves in this higher tax bracket when they retire than they were ever in during their earning years. And that surprises them because they were duped into being told that you'll likely be in a lower bracket. Okay. And so Congress keeps spending too much money. And so most people agree that taxes in the future will likely be higher, not lower. So between federal tax and then state tax, 41 out of 50 states has a state income tax. Many retirees will pay out at least a third in taxes, okay? So you pull out $120,000 before tax out of that mutual fund, and you pay 33% in federal and state tax. That's 40 grand. You're netting 80,000. You're netting 8% out of a 12% payout, okay? Now, if you have another 1% on that million that's being charged in asset management fees, that's another 10 grand. So you're earning 120, and after tax, you're netting 80. After 1% fees, you're netting 70. Many, many Americans with money in mutual funds, if they were to earn 12, they're only netting 7 or 70,000 a year to buy gas and groceries, prescriptions, and golf green fees on $1 million nest egg. So far, so good? Okay. Now, Dalbar, who studies investor behavior, they said that if you bought and held, you didn't get emotionally involved in the downturns in the stock market, you will not average 12%. You take any 20-year period since the Great Depression, and if your money is in a mutual fund, you're going to average 9.14%, okay, or less. Let's just round it to 9. So using the same theory, $1 million nest egg, you should be able to pull out 90 grand a year without depleting your $1 million, right? But that's before tax. Let's apply the same 33% tax. You pull out 90,000, you're going to have to pay 30,000 in tax. You're only netting 60,000, okay, which is 5 grand a month. Well, then you have another 10% in fees. So if you earn 9, you're netting 5. So you're only really netting 50,000. This is what most people think, and this is what a mutual fund generates, okay? Because you have to pay tax on it sooner or later, and then you've got your asset management fees. So the actual return, if you bought and held, would be 9, netting 6 after tax, netting only 5% after tax and fees. Now, Dalbar also says this: the average retiree is only really earning 3.49%, about 3.5% on their mutual funds. Why? Because they said there's a big difference between investment returns, which they said would average 9, okay, and investor returns, which is only 3.5. What's an investor return? They said most retirees, if you had $1 million saved in the market of mutual funds, and you see the market go through these, this volatility, and you see the market take a nosedive like 2001 to 2003, it dropped 40%. It took 4 years to come back to break even and make up what you lost. And then in 2008, in one single year, it dropped 40%. It took 4 more years to come back to break even. That's called the Great Recession. $1 million went down to 600,000 twice. In 12 years, it barely came back to $1 million. By the way, our clients with IUL, their million grew to 2.5 million during the same period. Okay, but if you look at the real world, retirees who have $1 million nest egg, they get super stressed out if that $1 million even dips down 20, 25, or 30%. Emotionally, they go, enough already. And what do? They sell. Most Americans panic because that's their nest egg. And they sell low. When the market drops 20, 25, 30%, sell. And then they wait till the market comes back up again, and then they buy back into the market again, and they buy high. That is the opposite of what you should be doing. And Dalbar says because of that emotional involvement, retirees are only averaging 3.49% with their money in mutual funds, okay? This is what precipitated the 4% rule in the financial services industry. And so broker-dealers, they realized that the average person, because of that emotional involvement, are only averaging 3.5. And so they came out with a 4% rule. They only want their asset managers to only illustrate 4% payouts. And if their clients take out more than 4% a year, the clients have to sign a waiver, a hold harmless, and they will not sue the broker-dealer or the advisor if they take out more than 4%, because they'll likely outlive their money. Yeah, this is true. This is called the 4% rule. So if you're only earning 3.5 and you pull out 4%, it will slowly deplete your nest egg, but not before your LE, the average LE or life expectancy. If you pulled out 4% and you're only earning 3.5, you won't outlive your money for most Americans' life expectancy. That's called the 4% rule. That's unacceptable to me. That's pathetic. Okay. So that's the reality of investing in a mutual fund. Now, an IUL, if you rebalance and you diversify, you can take an average return on an IUL from around 8% up to 11.17%. And you can watch other episodes on this channel to see this, because we have annual reviews with our clients. And we change from maybe a cap strategy to a no cap strategy, what is called a threshold strategy. And we have some years our clients get credited 25%, 61%, 158%. Not all years, but because of diversifying, many of our clients are able to earn returns of 11, 14% or whatever. So let's just go down to 11. Many of our clients will average 11 and net 10 cash on cash. So let's go back to the same $1 million. $1 million in an IUL will generate $100,000 a year of tax-free income without depleting principal. And so that's tax-free. That's $100,000 of tax-free income compared to how much out of a mutual fund. Earning 12, you're only netting 80,000 or 70,000. How much more is 100,000 than 80 or 70,000? Okay. But the actuality is, if you only earn 9, you're only netting 6 or 5. How much more is 100,000 than 50,000? It's twice as much. You'll get twice as much income out of an IUL than out of a mutual fund if you bought and held. But if you're emotionally involved in the market and you only pull out 4%, 4% on $1 million is only 40 grand. And you have to pay tax on that. You're probably only in a 25% bracket, not a 33%. So let's take 25% of 40 grand, that's 10 grand. You pull out 40,000, you're netting 30,000. I just showed you out of a mutual fund, you're going to be lucky to net 30,000 after tax. After tax and fees, you're going to be lucky to net 2% or 20,000. In an IUL, you can earn 100,000. How much more is 100,000 than 30,000 or 20,000? So when people say, can I do better? Good luck. You'll likely end up doing a double, triple, or quadruple what you would end up earning in a mutual fund. So don't get disillusioned by, in a mutual fund, you might earn 12. Well, what are you netting? What will a mutual fund with $1 million generate? Is it going to generate only 70,000 after taxes and fees, or 50,000, or 30,000, or only 20,000, when the same $1 million at an IUL can generate 100,000 a year of tax-free income without depleting principal? It's that simple, okay? And so if you want to see some actual examples, they are in my book, The Laser Fund. And also a certified IUL professional can show you a mutual fund compared to an IUL. And if you want to assume the mutual fund's going to earn 12%, they'll show you why an IUL will knock the socks off of a mutual fund, even if you use 12% as an average return, because of what I've been talking about in this episode, okay? So what I'm going to recommend that you do is that you claim a free copy of the Laser Fund book by going to laserfund.com or click on the link below. And when you go in there, you'll contribute a nominal amount towards the shipping and handling of this book. I require a little bit of skin in the game, but I'll cover the rest of that cost and I'll pay for the book. I will fire out a hard copy of this 300-page book to you via priority mail. Now, this is actually 2 books in one, okay? This one, the white covered side, is about 200 pages, 14 chapters with all the charts and graphs if you're a left brain learner. If you learn more by stories and examples, you're a right brain learner, you flip it over and read this one. This is about 100 pages, 12 chapters with 62 actual client stories. If you want to use your whole brain, then read the left and right brain books, okay? But when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's audio and video educational formats available. We also teach free educational webinars on a regular basis. Weekly, we teach a 90-minute webinar. We teach on a monthly basis a Retire by Design 6-hour webinar that will change your life, I assure you. But if you want to talk to an IUL specialist that's certified with no cost or obligation to see how a properly structured IUL will knock the socks off of a mutual fund, you can schedule an appointment to talk to an IUL specialist, and they'll be happy to provide that for you at no cost or obligation.